When it comes to investing in dividend stocks, you basically have two different options. On one hand, you can invest in dividend growth stocks, which focus more on companies and ETFs that typically don't offer yields of over 4%, but can potentially offer more dividend increases and long-term share price appreciation. On the other hand, you also have income investing, which focuses more on stocks and funds that don't offer much, if any, dividend increases or share price growth over time, but these investments usually offer yields upwards of 8%, if not more. Both of these investment types are appealing to me, and it's particularly rare to see investments that offer both high yields and dividend and share price growth over time. But a handful do exist, so in today's video, we're going to take a look at 3 different companies that currently offer yields of at least 7% and have offered steady growth over time. With that being said, let's go ahead and get started. The first stock we're going to take a look at is Hess Midstream, ticker symbol HESM. They're a fee-based, growth-oriented midstream company that owns, operates, and develops a diverse set of midstream assets. Hess Midstream owns oil and gas and also produces water handling assets that are primarily located in the Williston Basin area of North Dakota. They were founded in 2014, and today they conduct their business in 3 different segments, which are gathering, processing and storage, and terminaling and exporting. All of their contracts are 100% fee-based, which minimizes their exposure to commodity prices, and they're also long-term, with many extending past 2033. In addition, this stock also doesn't issue a K-1 tax form like a number of oil and natural gas companies do. They send out a regular 1099 just like any other dividend stock. Their stock currently trades for $30.88 per share, and they issue dividends quarterly. Their last was for a little under 57 cents per share, which gives this stock a current dividend yield of 7.25%. If we look at their dividend distribution history, we can see non-stop continuous growth over the long term for this stock. Actually, this company's been able to increase their dividend every single quarter since 2017, which is really impressive. It's not necessarily by a whole lot. Some quarters they increase it by a few cents, sometimes it'll only be by less than a cent. But regardless, dividend growth is still growth. Their stock is actually up over the last year, and it's seen good growth since their IPO in 2017. It doesn't look like a whole lot since it's only up about $5 since their IPO, but remember, those massive dividends that they're paying are playing a big role in the overall return for this stock. Hess Midstream is a relatively new company in this field, but that's only because this company is a spin-off of Hess Corporation. They're a large international energy company based in the US that's involved in crude oil exploration and natural gas production. In 2017, they spun off HESM into its own business, which is pretty small in comparison to some of their peers, including Energy Transfer, Enterprise Product Partners, and Kinder Morgan. Despite their small size though, their stock has been the best performer out of all of them in the last 6 years, at least up to the making of this video. None of these other companies have been able to increase their dividends as much as Hess Midstream, but their small size is probably one of their biggest risks. As with all oil stocks, it's good to be well educated in this industry and how oil prices can impact their performance. John Hess, who's the current CEO of Hess Corporation, makes regular appearances on CNBC, and he highlights some really important facts about the oil industry. Even though the US and the world keeps promoting greener sources of energy, the fact is the world and the US are still going to heavily rely on oil. I've shown this graph before when discussing other oil companies, but you can see so much of what we use on a daily basis still heavily depends on oil. So it's definitely nowhere close to being a dead industry, and dividend investors who choose to ignore this sector can really lose out on some hefty dividends. The next stock is the Reeves Utility Income Fund, ticker UTG. Although it's not like the other stocks on this list because this is a closed-end mutual fund company, otherwise known as a CEF, it has been a great long-term performer. The Reeves Utility Income Fund's objective is to provide a high level of after-tax total return consisting primarily of tax-advantaged dividend income and capital appreciation. They invest at least 80% of its total assets in dividend-paying common and preferred stocks and debt instruments of companies within the utility industry, and the other 20% being in other sectors. This fund was introduced back in February of 2004, and it holds a wide range of different utility and communication companies inside it. The stock also pays monthly dividends, which is really nice. On the fund's fact sheet, it shows a breakdown of their dividend distribution since 2017. Back then it was paying roughly 16 cents per share per month in dividends, where now it pays about 19 cents per share. You can go on Yahoo Finance and look back even further and see that since this fund's inception 19 years ago, they've never reduced their dividend. When it was first launched, it was paying about 10 cents per share, so it's nearly doubled since its IPO. Looking at its share price performance, we can see their stock is up about 68% since their IPO. Again, not a whole lot compared to a lot of other growth companies, but remember, the dividends account for a significant amount of the total return here. Right now, this fund offers a dividend yield of 7.64%. I'm not going to break down what a closed-end fund is since I've already done that a few times recently, but a CEF is really similar to an ETF, only they have a limited amount of shares available and they can use leverage to a certain degree to boost returns. But on top of paying regular monthly dividends, this fund's also paid special dividends every now and then. But in terms of what kinds of dividends it pays, it varies from month to month. You can see on their fact sheet some of their distributions are classified as qualified, some are non-qualified, and some are considered long-term capital gains. The industry breakdown is roughly 64.6% utility holdings, 16.5% communications, and then the remaining 18.9% are spread out among other assets including real estate, industrials, and energy companies, as well as cash. It currently holds 41 different investments as of September 30th, and it has over $2.4 billion worth of assets inside it. Up to this point, this fund's been a real gem considering the great track record that it has. Since this fund's IPO, it's outperformed the S&P 500 over the last 19 years. According to the DRIP calculator, UTG's provided an average annual return of 9.53% compared to the S&P 500's average annual yearly return of 8.8%. A $10,000 investment into this fund right after its IPO would now be worth nearly $56,000 today. I'll also mention that there's another fund out there that's similar to UTG, which also offers a high monthly dividend yield, and that's ticker symbol UTF. This fund targets more infrastructure holdings though, and it doesn't have as great of a track record as UTG. Plus they did cut their dividend, but it was all the way back in 2009, which isn't bad. But UTG is still my favorite out of the two. This next stock is CTO Realty Group, which is ticker symbol CTO. They're a publicly traded real estate investment trust that owns and operates a portfolio of high-quality, retail-based properties located primarily in higher growth markets in the United States. They also own a sizable stake in another REIT called Alpine Income Property Trust. According to their latest investor presentation, this company only holds 20 different properties, but I feel like this is misleading because the properties are really big. While a lot of other REITs own individual restaurant buildings, for example, the properties that CTO owns are these really massive shopping plazas, all of which have typically dozens of individual retail stores. This is one of their shopping plazas in Georgia. You can see that one property is really more like 75 when each store is accounted for. CTO currently trades for $19.07 per share, and it offers a dividend yield of 8.01%. This company's actually been around since 1902, but in December of 2020, they announced they were converting their business to a real estate investment trust. As highlighted in their investor presentation, once they did this, the dividend growth was pretty significant. But even before becoming a REIT, they had a long history of increasing their distributions. They pay dividends quarterly, with their last being for 38 cents per share. Over the long term, this stock's share price has grown more than anything else we've looked at so far, but obviously they've been around much longer, so it's not really a fair comparison. They do have the best share price performance though over the last 10 years compared to everything else we've looked at so far. Because CTO owns retail centers, there's some concern about how they might be impacted by a serious recession. One good thing that separates them from other retail REITs is that they've been targeting retail centers in more affluent areas. It's somewhat of a newer strategy for this company, and I think it shows that management knows where the consumer trends are heading. Some of the older properties in their portfolio are more like traditional strip malls and grocery-anchored shopping centers, but their newer property acquisitions are more like mixed-use retail centers. These are more high-end shopping center areas that might also include entertainment venues and more upper-class restaurants. According to their demographic portfolio, the average household income of those who live within 5 miles of their shopping centers is over $136,000 a year. These people would be significantly less impacted by a recession if what we're about to go through does get a lot worse. Additionally, a good amount of the companies that they lease their properties to don't have leases expiring anytime soon. Almost 20% of their tenants have signed leases that don't end until after 2031. Their lease occupancy rating, though, is about 93%, which is lower than average. But overall, CTO is a decent pick for people looking to bear more risk and get a higher dividend yield. But I'm not as optimistic about this stock in terms of being able to dramatically increase their dividends like they have been in the past couple of years. Given the current risks, I'm not currently a shareholder of this stock, but it's one I continue to keep my eye on from time to time. And that's going to conclude our look at some dividend holdings that have offered both high yield and dividend growth. Although the amount of growth for each holding varies a lot, everything we've looked at up to this point continues to grow upward. There's obviously no guarantee that any of these holdings we looked at will be able to keep growing in the future, but their track records have been really strong up to this point. But as usual, be sure to perform your own research and due diligence before making any investment decision. Let me know in the comment section if you happen to own any of these holdings and what your opinions on them are. With that being said, thank you all so much for watching today's video, and until next time, take care.